Welcome back to Sip and Talk.
Hey, everyone.
Today is EP408-2. Let's get into today's topic.
Okay, let's do it. We've got a lot of ground to cover today.
We really do. We're looking at the magnificent 7's AI race. Hardware seems to be peaking, so who's going to lead the software future?
Right, and we absolutely have to talk about the macro picture, too. Those trade war shockwaves are definitely making things interesting again.
Yeah, it's a collision course. We've got a ton of fresh data, key events, lots to unpack for you.
And just our usual reminder, this is us analyzing the situation, connecting the dots based on what we're seeing. It's definitely not investment advice.
Although, it's hard not to notice that a lot of institutional players seem to view those recent dips as a buying opportunity.
They certainly did. Classic buy the fear playbook for some.
Okay, so let's start with that macro storm. The trade war stuff really hit the fan earlier this month, didn't it? October 2025.
Wow. It was intense. You couldn't miss it. President Trump floated those potential new tariffs on China, and the market just reacted violently.
Yeah, but the reaction was incredibly fast. Just wiped out, nearly a month of gains in one day?
Pretty much. The numbers were stark. Dow down 878 points. NASDAQ took a huge hit, down 820. S&P 500 lost 182. Just boom.
And the pain wasn't spread evenly, was it? Where did it hurt most?
Oh, semiconductors. Absolutely hammered. That's always the nerve center in this U.S.-China tech tension.
Right.
The Philadelphia Semiconductor Index, the SOX, it dropped over 6.3%. And you saw big names like TSMC's ADR fall over 6% too.
Ouch. That tells you where the market sees the immediate vulnerability.
Exactly. But the tactic itself was, almost predictable, wasn't it?
And the hard-soft thing?
Yeah. You throw out the huge threat of 100% tariff kicking in November 1st.
Yeah.
Market freaks out, naturally.
Great. Maximum impact.
Then just hours later, you kind of walk it back slightly. Trump saying Xi just had a bad moment. The U.S. wants to help China, not hurt it.
It's negotiation theater, pure and simple. Designed to push China back to the table, but maybe from a weaker position.
Precisely. And what's really fascinating, and something we need to understand, is how investors are processing this now. It's like it's become financialized.
The financialization of political events. Okay, let's unpack that a bit, because that feels like a key insight. You mentioned the TACO trade.
Yeah, TACO.
Yeah.
It stands for Trade, Act, Collect, Offset. Basically, the big institutional players, the algos, they've seen this movie before.
Okay.
They know the announcement, the trade, will cause volatility. So they act on that, maybe sell, maybe position short. Then they anticipate the eventual walk back or stabilization, the collect phase, where they might buy the dip, and then they offset their initial risk. It's become this sort of event-driven arbitrage loop.
So wait, if the market just treats these big geopolitical threats as like a short-term trading opportunity, a taco trade, doesn't that kind of weaken the whole point of the threat? If nobody really believes it'll stick, or they just see it as noise to trade around, does the tariff threat lose its punch over time?
That is a really, really good question. And you see hints of it in the data, like the CNN Fear and Greed Index. Yeah, it dipped back into fear.
Okay.
But the VIX, the Volatility Index, it spiked, sure, but it didn't necessarily go completely crazy like in past crises. We're seeing commentary that maybe a VIX around 20, even 25, is kind of becoming the new normal baseline.
Interesting. So underlying strength may be masking the political risk.
Could be. Or maybe it's just that the market is pricing in the volatility as standard now. The bigger risk, the one the taco trade maybe ignores, is that this decoupling, this split, it feels kind of irreversible, doesn't it?
Yeah, that feels like the structural shift underneath the noise. Which brings us to China's move. They didn't just sit there, they hit back.
They did. They pulled out the big gun.
Yeah.
Rare earths, expanding export controls significantly.
And the way they did it was interesting, too, using that U.S. tactic against them.
Exactly. For the first time, they explicitly used the Foreign Direct Product Rule, the FDR. That's the same long-arm legal tool the U.S. used to choke off China's access to advanced semiconductors.
Wow. So turnabout is fair play, huh? What does this China FDR mean practically?
It means even if a product is made outside China, say in Vietnam or Mexico, if it contains even trace amounts of specific Chinese rare earth elements, you now need a special export license from Beijing.
Whoa. That's a wide net. Who gets caught in that?
It hits U.S. defense contractors for sure, but also critically, anything using high-performance magnets. Think NdFeB magnets, neodymium iron boron.
Okay, yeah. Where are those used?
Everywhere. Important. High-efficiency electric vehicle motors, wind turbines. It's a direct shot at industries the U.S. wants to dominate, and it definitely puts pressure on companies like Tesla.
Because their EV production relies heavily on those specific magnets.
Absolutely.
Yeah.
And the leverage China has here is just immense.
What are the numbers again? It's huge, right?
It's staggering. China controls something like 70% of the global supply of rare earth minerals. But more importantly, over 90% of the processing and the actual magnet manufacturing.
90%. Wow.
Yeah. So the U.S. simply can't decouple this quickly. It's not possible. Even with initiatives like the Defense Logistics Agency putting $1 billion into purchasing strategic minerals.
$1 billion sounds like a lot, but compared to 90% control.
Exactly. Projections suggest the U.S. might struggle to get its domestic share of processing up to even 10% by the end of this presidential term. The environmental hurdles, the permitting, it just takes years and years. You can't just wish a mine and processing plant into existence.
That dependence really highlights the tangible risk behind the political posturing. It's not just tariffs.
For sure. And there were other friction points too, right? Smaller things, but they add up.
Yeah, like China completely halting U.S. soybean purchases this year, shifting all that business to Brazil and Argentina.
Right. And that almost weirdly petty ship war, with both sides slapping extra fees on each other's vessels coming into port, just adds more grit in the gears of global trade.
Okay, so that's the macro storm, the external pressure. Let's pivot now, inside the tech world, to the Mag 7. How are these giants navigating this? Because the AI race itself seems to be shifting.
It absolutely is. We're moving past the initial, land grab phase.
The hardware arms race.
Yeah, exactly. Everyone just frantically buying GPUs, pouring money into building up the basic infrastructure. CapEx, capital expenditures, were projected to hit this insane number, like $368 billion in 2025.
$368 billion. Wow. But that's peaking now.
That's what the latest analysis suggests. Growth in that kind of spending is expected to slow down significantly, maybe to around 12% by 2026.
Why the slowdown? Diminishing returns.
That seems to be the consensus. Just adding more and more GPUs gives you less and less of an edge. NVIDIA is still the king, no doubt. 80% market share, huge demand for their Blackwell chips. But the real long-term value, the sustainable advantage, it's moving up the stack. It's shifting to software.
Okay, so where specifically is this new battleground, if it's not just hardware?
I think it's in 3 key areas. First, the models themselves. Who develops the most powerful, most efficient foundational AI models? OpenAI with GPT, Google with Gemini, Meta with Llama. That race is intense.
Right, the core brain.
Second, applications and ecosystems. How do you actually use the AI? Integrating it seamlessly into stuff people use every day. Think Microsoft's Copilot in Office, or AI deeply embedded in search, or Alper finally delivering a truly smart Siri 2.0.
Making AI useful and sticky.
Exactly. And third, the platform. This is where the cloud giants really play. AWS, Azure, Google Cloud. They provide the entire toolkit, the computing power, the storage, the security, the MLOps tools that businesses need to build and deploy their own AI safely and reliably.
Models, applications, platform. Okay, that makes sense. That gives us a great framework to look at the individual Mag 7 companies. Let's spotlight them through that software lens. Where do we start? Got to be Tesla, right? The ultimate wild card.
Absolutely. Tesla's story is just fascinating because it's cold in 2 directions. On the one hand, the AI potential is just massive.
Yeah.
They have the highest projected earnings growth, that EPS EGR of 48%. That's driven by software full self-driving, which apparently has like a 50% profit margin.
50%, wow.
Yeah. And then there was that Optimus robot demo back on October 12th, people calling it revolutionary. Plus the whole robo-taxi network, projected to be worth over $100 billion by 2026. That's the AI dream.
Okay, that's the huge upside. But we just talked about rare earths. That's the hard risk hitting their core business, right?
Absolutely is. That's the vulnerability. The EV motor production is directly in the crosshairs of those Chinese export controls.
But is there a counter-argument? A hedge?
There is, actually, and it's clever. Remember how AI data centers are going to need insane amounts of electricity? Like 4x increase over the next decade.
Right, the coming electricity bottleneck.
Well, Tesla's energy storage business is perfectly positioned to benefit from that. Managing and storing power for all that AI infrastructure, that's a huge, maybe overlooked advantage for them.
Ah, the energy play. That's smart. Okay, so Tesla's the high risk, high reward wild card. What about the steadier players? The cloud giants, Amazon and Microsoft.
Yeah, they feel like the safest bets for this software transition. They already own the platform layer, which is critical.
Amazon first, AWS still dominant.
Yep, holding around 30% cloud market share. And that massive CapEx spend, their $100 billion they're pouring into infrastructure.
Yeah.
That's fueling some pretty wild predictions. People talk about Amazon potentially hitting a $5 trillion valuation, largely because they're building the capacity to handle that explosion in data center power demand we just mentioned.
$5 trillion.
Okay.
And Microsoft.
Equally strong position, really. Azure is booming, and Copilot is getting huge traction in the enterprise market. People are using it. It's sticky, and the margins are incredible, reportedly around 40%. They're executing really well on that application and platform integration.
So AMZN and MSFT look well positioned. Which brings us to the elephant in the room.
Yeah.
NVIDIA. Is the bubble talk real?
Look, the concern is definitely out there and growing, especially after that NBC report came out detailing this huge, almost $100 billion kind of circular investment flow.
Circular flow? Between who?
It involved NVIDIA, OpenAI, the cloud provider Oracle, and this big AI cloud startup called CoreWeave.
Okay, how does that work? Why is it circular?
Well, think about it like this, and this is simplifying, but Oracle invests heavily in CoreWeave. CoreWeave's main cost, buying tons of NVIDIA GPUs.
Right.
NVIDIA, meanwhile, invests in AI model companies like OpenAI. OpenAI needs massive amounts of cloud computing, often from places like Oracle or CoreWeave.
Ah, okay. So the money kind of flows in a loop between these players.
Exactly. It creates this impression that maybe some of the demand isn't purely organic from end users, but more like an ecosystem investing heavily within itself. And that's what draws the comparisons to the dot-com bubble, where similar circular funding patterns emerged.
That makes the concern much clearer. And NVIDIA is also facing real competition now, finally.
Yes. AMD's MI355X chip is hitting the market. And the reports are suggesting it offers maybe a 20% lower total cost of ownership compared to NVIDIA's current chips.
20% lower TCO is significant.
It is. Now, NVIDIA still has the huge advantage of its CUDA software ecosystem. That's a deep moat. But the pure hardware dominance is definitely being challenged.
Okay, one more Mag 7 giant, Apple. Usually the bedrock of stability, but they've seemed a bit slower on the AI front lately.
Yeah, Apple's more of a resilient story right now than a rapid growth one. Their projected growth is slower, maybe 12.5% CAGR. That's partly due to delays getting Apple Intelligence fully rolled out and also facing weaker demand in China.
But resilience is key in this environment, isn't it?
Absolutely.
Yeah.
And Apple has it in spades. First, their vertical integration with Apple Silicon gives them incredible control. Second, they've been the most aggressive, arguably, in de-risking their supply chain.
Moving production out of China.
Yeah, shifting manufacturing rapidly to places like India and Vietnam. That makes them much less vulnerable to something like the rare earth controls compared to, say, Tesla, which is more exposed through its EV components.
That supply chain diversification is a massive hedge against the geopolitical stuff we started with. Smart move.
Definitely.
Okay, before we wrap up, let's do a quick global check-in on a couple of other things happening. Middle East.
Right. So President Trump announced that the Gaza war had effectively ended. He was planning a trip to Israel to witness a significant prisoner exchange, 20 live hostages reportedly, for 2,000 Palestinian prisoners.
That sounds like a major development.
It is. In terms of stopping the immediate fighting and getting some hostages home, it's a diplomatic win. But we have to remember the underlying issues, the core drivers of that conflict. They haven't gone away. This feels more like a pause than a permanent resolution.
Understood. Okay, shifting to Asia. Japan had a big political shock.
Huge. The ruling coalition between the LDP and Komeito Party, which had been in power for like 26 years, it collapsed. Just fell apart.
Wow. What does that mean economically?
Immediate uncertainty. And that flows straight to the Bank of Japan. They just got way more cautious. Market odds for an October rate hike, which were pretty high, like 70%, just plummeted down to around 20%. Political instability equals monetary hesitation.
Gotcha. And one last quick one, crypto. We saw some fireworks there, too.
We did. A massive, historic, single-day liquidation event, something like $19 billion wiped out. Reports suggested part of it was due to technical issues like exchange disconnects.
$19 billion. Did it crash the market?
That's the interesting part. No. Bitcoin actually rebounded pretty quickly, back up to around $115,000.
What does that tell you?
It suggests maybe the market is maturing. In past cycles, an event that size would have likely triggered a much deeper, longer crash. The quick recovery, plus the explanation of exchange issues, seems to be accelerating the move towards decentralized exchanges and people holding their own keys. More resilience in the system, perhaps.
Interesting times across the board. Okay, so let's bring all this analysis together. If you're listening to this, trying to make sense of it all, what's the key takeaway?
I think it's try not to get completely whipsawed by the short-term trade war headlines.
Yeah.
That taco trade phenomenon shows the market often treats it as noise.
Right.
The really crucial thing to focus on, I think, is understanding the two big, probably irreversible shifts happening underneath. First, the geopolitical decoupling. It's real. It's structural. Second, the AI value chain moving decisively towards software, platforms, and ecosystems.
And maybe a final provocative thought for you to chew on. If the AI race really does become about software ecosystems and controlling the user applications, maybe the ultimate strategic asset isn't the fastest chip or the biggest cloud data center. Maybe it's controlling the on-ramps, the devices and interfaces people use every single day, which could mean the eventual winners might look different than the current hardware leaders.
That's a really interesting angle. Who owns the user relationship? That could be key. And just to reiterate, as always, our goal here was to connect the dots based on the information available, staying objective, without any bias towards any group or nation. We just want to help you think independently.
Absolutely. And if you found this Sip and Talk helpful, please do subscribe so you don't miss future discussions.
Yeah, we'd appreciate that.
Also, give a shout out to our old friend Mickey. Check out his YouTube channel, Mickeytolife. He's got fun stuff over there, memes, music, wine tasting, travel vlogs. Just good vibes.
Definitely check out Mickeytolife.
All right, that's all for this time. We'll catch you next time.